So, okay, we are going to start now. Uh, should we? Okay, so we are doing mutual funds. So maybe today we'll be covering and completing the mutual funds. Okay, and then we move on to the next chapter. So we are talking about, we have done equity funds, how to select them, how to find out, which fund is, performing better, which is not. So in the last lecture, which was online, I just gave you some idea about the funds, the debt funds. Okay, the debt mutual funds. Now, equity mutual funds, they give you a very good return. I'm recording this, okay? That's why I'm just sitting here. If I move out, then my voice will not get recorded. So, so debt mutual funds, basically, okay? Now, the debt mutual funds, they don't give, that much of return, which the equity mutual funds can give. But equity mutual funds can even make losses because they are riskier. The stock market can go down and you can lose money. But over a long period of time, they tend to give wonderful returns. But people generally put their money into debt funds also. Okay, because it's not all equity. A person should put money. It all depends. If you are a young person, young like you should be putting almost like 90% of the money or even 100% money in equity funds. But if you, as you grow, you want to bring some safety. Okay, so invest in debt funds. Okay, so which gives you about, on an average around 7% return, sometime low, sometime little higher. Uh, but they give you around 7% kind of return. Okay. Uh, Now, debt funds are of various categories. Okay, as we have seen, if you just go to this site, now these are all the debt funds. Okay, and of course, you to understand debt funds, it's not very easy because it's a little complicated topic. Uh, because there are a lot of terms being used there, so I would like to give you a full idea about, and you must understand because after all you have to have complete knowledge. So it doesn't mean that you invest only in equity, but you will put your money into debt, as well as when you join companies or join a financial company. So it will help you basically that you will be having a very good knowledge and deep knowledge about debt funds, and it is a must be. Because at my investing level, I invest around 50% to debt funds and 50% to equity. Okay. Normally, it's like 100 because earlier 100 minus the age should be into your equity and balance should be into debt. But now it is 120 minus the age decides about how much should be in equity, how much should be in debt. Okay. So as you can see, there are low duration funds, short duration funds, medium duration funds. So there are variety of funds, and they are talking about something called duration. So duration you must understand because when you buy these funds, they invest in bonds, they invest in treasuries, bonds, all fixed income securities. Okay. Now, when you buy a bond, when you buy a mutual fund where the money has been put into fixed income securities, mostly bonds. Now bonds are various maturity periods. It can be 3 months, 6 months, 2 year, 5 year, 10 year, 20 year, 30 year. Government also issues bonds as well as corporates issue bonds, and they carry a coupon rate. Okay? Like when you buy a bond typically is priced at 100 rupees and will carry a coupon rate 6%, 7%, 9%, likewise. So you will be getting that return. Whatever the coupon is there, you will be getting that interest on your 100 rupees. Suppose you buy a bond of 100 bucks, which has a coupon rate of 7%. You get 7 rupees per annum. Say 10-year bond. For 10 years, you're going to get 7 rupees, and on the 10th year, you're going to get 100 rupees back along with your 7 rupees interest. That's a simple, bond. So, so these bonds can be either for short duration or for long duration or a medium duration. Now bonds are, basically listed on the stock exchange. Most of the bonds get listed on the stock exchange, and you can buy them from the market instead of buying from the company or from the government. You can buy these bonds from, from the stock exchange. So directly. But instead of buying directly, because we don't know which bond is better, which is not. So we can buy bonds, we can buy mutual funds who are invested in bonds. So that's always the indirect way of investing into bonds. Like you can invest instead of buying shares, you can buy mutual funds which are buying shares. Okay. because that is always, you get full diversification benefit, and they are managed by professionals. Okay, they charge you some money, but you are very sure about, you don't have to monitor about, those bonds and shares individually. So you can buy mutual funds for doing the job for you. Okay. Now, so bonds are listed on the stock exchange. Okay. So you can, that's a secondary market, isn't it? So you can buy either from the primary market or the secondary market. Okay. The primary market is buy the bonds from the issuer, from the company, or from the government directly. If you buy a government bond, you have to go to RBI site and buy it. But if you want to buy a bond, you can even buy it from the exchange. So it's a secondary market. So it's a second-hand bond. Right? It's already been bought by someone and you are buying from someone else, not from the company or from the government itself. Now those bonds can be sold at the price at which they were issued, or it can either go up or go down. Okay. Now that's very important thing, because these bond prices can go up or go down. Now, why the prices go down or why the prices go up? Any idea? Because I gave that this thing in your mind, getting some sense about it. Why, at what time the bond prices will go up? One answer. Anyone? Bond prices can go up. How the bond prices go up? 100 rupees bond can be selling at 105 in the market, so you have to pay more price to buy 100 rupees bond. Okay, please. Or you can buy it even at 95 rupees, because bonds are listed. Okay, and if the interest rate goes up, suppose the bond was issued at say 8% coupon rate, and interest rate now is 10%. Now the same way bonds are issued at 10% by the same company. So you will buy a 10% bond from the company rather than buying from the secondary market, because it will give you 8% return, isn't it? So the 8% bond, which is a second-hand bond, will be selling at a lower price. Okay, compared to 100 rupees, which is good because it's selling at lower price. Because nobody is going to buy it. Because you have a choice to buy a bond at 10% coupon rate rather than buy at 8%, which was about 2 years back. It's a 10-year bond, still about 8 years to go. So you can buy it from the secondary market. But if somebody gives a discount to you, you will buy it. Okay, how much discount? The discount which will actually give you a same return of 10% at least if you buy it from the primary market. If you go to the primary market, you're getting 10%. But when you go to the secondary market, 100 rupees bond is selling at 90 rupees. Okay, so if you buy at 90, but you are going to get 100 rupees back from the company at the end of the maturity. So 10 rupees is capital gain you're getting. So if you add that to the coupons at lower rate, say 8%, it will come to a return of say 10%. So you will be feeling that it's okay to buy a bond at 90 because it's going to give the same return, isn't it? So you buy the bond, second-hand bond at a lower price in the market, if it gives you a similar return, which a new bond which has been issued by the same company at 10%. But if the interest rate goes down, then the bond, which are old bonds, are issued by company earlier, because they will be in more demand, because they are getting a higher coupon rate. Suppose they are issued at say 10% coupon rate, and the new interest rate is about 8%. The company is issuing at 8%. So if you go to the company and buy a bond, you will get 8% return. So if you go to the secondary market, you get 10% return. But the person who holds that bond at 10%, he's not a fool, he's not going to the bond sell the bond at 10. He can charge you up to 710 rupees. Okay, fine. So if you just work out that if I buy this bond at 110, I get the same similar kind of return of 8%, which is equal to the new coupon rate. So if you have a choice, whether to buy the old bond and new bond, you will still get 8%. But if sometimes the price is lower, okay, you may get 10.5% return. Then you say, okay, fine, let me buy a second-hand bond because it gives me a higher return compared to the new bond which is issued at 8%. Have you got it? Is it clear or not? So now tell me, under what circumstances the bond prices will go down? Bond prices will go down when the interest rate rises. When the interest rate rises, the bond prices go down. There is an inverse relationship between the bond price and interest rates. Have you not studied this in your earlier semesters? Have you or not? Those who have studied this, raise your hand. Of course, maybe that you're doing it after a long time. Okay. Anybody here? No. You haven't studied. I am. Maybe morning time, still early for you. I get up at 4 o'clock. You will be getting in 9 o'clock, 10 o'clock. So still it is taking time for you to speak up. So the bond prices basically go up or go down, depending on the interest rate prevailing in the market. Okay? If the interest rates go down, the bond prices go up. And it's a very, very important relationship of interest rate and bond prices. Never ever forget this. Very, very important. The interest rate goes up, bond prices fall. Or when the interest rate falls, the bond prices go up. So simple to understand. Okay? And let me just demonstrate that to you. Okay? Through an Excel sheet which I shared with you. So if you have a laptop, you can just open and you can play around and find out what happens to the bond prices when the interest rates go up and down. Okay? Let's first understand that. So I've just shared a new file on your WhatsApp. So if you can open it, then it's a revised version of my earlier file. So just first focus on what I'm doing, and then in the meantime you can open your laptops and open the file and be this thing. Don't miss out what I say. Okay. Suppose there's a bond which was issued at 100 rupees. Okay, 100 rupees was the price at which the company charged. Minus 100 because you are paying that money and getting the bond. From your side, the money is going out from you. That's why I put a minus sign, because the formula will look like that. So it was, this bond was issued. We start. Yeah. Okay. Now, please focus here. Whosoever has joined late, please listen. We have just started something. So this is the most important thing in your life. Imagine that. Okay. You can't miss it at any cost. Okay. Just focus and understand. Just look at my screen, and then I'll allow you to just do it on the screen yourself. Okay. So this bond was 100 rupees. Okay, and it carried a coupon rate of 7%, and the maturity was 10 years, which means if you buy this bond at the time when this bond was issued, you will buy it $100, and the coupon rate is 7%. That means you're going to get 7 rupees throughout the life of the bond, which is 10 years, and at the 10 years you're going to get 107 rupees. Is that okay? Now, if you are a bond holder, now you can be a bond holder where you have an idea, or you have an intention to hold the bond till maturity. You can be like that, or you would like to speculate on the interest rates and may even exit the bond if the bond price goes up. So you can be of two categories. Okay, so there are two categories of investors. One who would like to stick with the bond. Okay, and they would like to hold the bond till maturity. For them, there is no loss, no gain. They are going to get the coupon rate as well as the principal money back from the company. Okay, these are called held till maturity, HTM. Okay, held till maturity, and for sale. So, so they can be, you're buying a bond for sale. Is stands for what? I mean, A stands for what? Any idea? I just read it. So this is for sale. So either you buy a bond for holding till maturity, or you're buying for sale. Now banks invest a lot of money in bonds, or the government bonds, and they have to classify the bond as HTM or AFS. Okay, they have to classify. They have to tell it before, and then the necessary accounting standards may apply. Okay, fine. So I'll talk about this, and again, as an individual, you can buy the bond if you have intention to hold it till maturity. Of course, you can change your decision and sell it anytime. But if you hold the bond till maturity, then you are not going to make any loss or any gain because the interest rates move up and down, isn't it? But if the interest rates move up and down and you're holding the bond for sale, you are either making a loss or making a gain. Or you will wait till the time you make a gain and then sell the bond. Or if you are so desperate, you can sell it at this discount. Is that right? Now, so those people are coming late, please come on time. Next time, after 10 minutes, you will either lose some marks, okay, or you will lose attend the class. So 10 minutes maximum allowed after the class starts. And anybody who comes late, he will either be deduct 2 marks from their overall assessment. Okay, fine. So remember that. I'll still allow it. I don't want it to lose on what we are learning, but you can just afford to lose some marks. Okay. So now this bond is 100 rupees bond carrying a coupon rate of 7% and a maturity period of 10 years. Okay. Now let's say the above bond was issued in 2021 and it will mature in 2030. So if you buy the bond at 2020, 100 rupees, then 7 rupees you are going to get till the maturity. Okay. So what is your return? 7%. Very simple. Now, there is a formula given here, and you must notice that, though it is very simple here because it doesn't require any formula to calculate what return you are getting, but still I put it because it will be used. So, this is called IRR formula, read at the top. Okay. So, here what we do is the formula is like this, IRR, internal rate of return. Okay. So, what we do is basically we book all the values right from 100 rupees till the end where you're going to get 107. Okay. Fine, and just enter it and you will get 7% return. Is that? So if you have to calculate the return of the bond, okay, because you may be buying even at a lower price or higher price, because bond prices can go up. So you must know what is the IRR. Okay, fine. So I'll explain that now at a later. Suppose after 2 years, the current interest rate is 6%. Now, when somebody bought this bond, it was issued by the company, it was giving 7% coupon rate. But now, after 2 years, scenario has changed. The interest rates have come down to 6%. What will happen to this bond? This bond will go up to 106 rupees. Okay, fine. Because it will maximum, it can go up to 106 rupees 21 paisa. Because if you buy this bond at 106.21, you are going to get a 6% return, which is equivalent to the interest rate of the present bond. Because the new bond which is issued by the company is at 6%. If you buy that, you are going to get 6%. The old bond price will go up to 106. That means you are going to spend 106 rupees 21 paisa. That is a minus sign. Okay. And then what you are going to get? You are going to get 77777 and 107. Same for the balance period of say 8 years. Is that okay? So if you use this formula here again, fine. So if you have to calculate your IRR again, so you can just do it. Recently use IRR and choose all the values from here to here, and then select. So you get 6% return, isn't it? Now tell me if this bond can go up to 106.21. Suppose you go to the market and you find this bond is selling at 105 rupees. Now my question is, will you buy a bond directly from the company or from the secondary market? Huh? From the what a secondary market, because there the bond is cheaper because it is available at 105. It is worth 106 rupees 21 paisa, but the market has not reacted to the interest rate because it's sometimes slow to react. So you can buy the bond at 106, 105 rupees. Any price below 106.21 will be beneficial. Okay. Suppose I say it's 100. Let me just change this number to 105. Suppose this bond is selling at say 105. Okay, because here I not changed, so it's the return will go up. Okay, let's see. If the coupon rate, so the price will be 106. If the coupon rate of similar bond is 6% in the market, this bond will be selling at 106.21. Okay. Now, because if the interest rate goes down, the bond prices go up. Okay. Now, if the interest rate goes up, okay, it goes to 8% because the fresh bond is issued. Now, this bond will be selling at 94.25. The same formula. Is that okay? Fine. Is it clear to all? Okay. Now there can be two scenarios. The first scenario like this. Uh, who's going to read? Just read. What is written? What is this a question? Okay. No attendance for the day. Or you use 5 months on a class practice. I'll be right. What's the option? Better. Huh? No? No attendance. But you don't want to lose marks. That your attendance will be or next time say you will lose marks. Okay. Now, is it okay? This question is there on your screen. Just try to solve and get this answer. Okay. On your screen. Just have a look at this. Now, this bond is selling at 106, and how many years are there? 7 and 8% of the coupon rate, and apply the formula and calculate yield to the chart. Let's do it. What's the time? Then you come on. Why you can wait? See, it's like this. I'm just putting my cursor here again, okay? And if I put my cursor here, it's IRR, okay? I have to calculate the IRR. So now, if this bond is selling at 106 rupees, my yield to maturity will be 6.39%. Okay. If I buy this bond from the market, I am going to get 6.39% return as against 8% at which the bond was issued earlier. But since now the interest rates have come down, so if this interest rate suits me, I'll buy it. Okay, I'll pay the premium. I'll buy it because if I buy a fresh bond, maybe it's selling at 6% coupon. So this is giving me 6.3. I'll buy it. Okay, have you got it? Should I still solve it? No. Okay. Now let's talk about the next one, the bond price. Okay, just read this question. आप पढ़िए. Shubhangi, just read it. Okay, so you have to calculate the market price of the bond. The bond face value is 100. Coupon rate was 12%. Year to maturity is 7 years. Current coupon rate is 8%. Okay, so that means the current coupon rate is less compared to the what it was issued earlier. So bond prices are going to, this old bond will be selling at a premium, isn't it? So how much? At 120. So calculate the market price. So here what we do is we use NPV formula. Like I'll just put my formula here and choose the formula here and choose the NPV, net present value. Okay, NPV. Just look at me, NPV. So here I'm going to put the current rate, which is 8%, current coupon rate. Okay, 8%. So 8%. Okay, and then I'm going to select the values. Okay, right from this. So okay, sorry, NPV. Let me just NPV. So NPV, here I have to put the 8% coupon rate, which is the present one, and select the values from here. Not because this is not given. I have to calculate 120 rupees. Okay. So I'm going to say like this. Okay. And if I do that, sorry, it's coming on the first line. Values will come here. Okay. So if I choose OK, I'll get 120 rupees. So that means If I buy this bond, which was issued at $100 earlier, carried a coupon rate 12%. So if I buy this bond, I'll get 12, 12, 12, 112. Okay. But I have to buy it because the secondary bond. Okay. So I want to know at what price it should be available in the market. What is the price at maximum it can go up to? So I'll say that the price is 120 rupees. This is the real price at which it should be actually selling in the market. But suppose this bond is selling at say 115 rupees, then go ahead and buy it because we have a good deal with you. Okay? Because then in that case, the return will go up beyond 8%. Is that okay? Got it? Okay. Is that clear to everyone? Now we come to the two a couple of things. Okay, so there are various concepts. Okay, one is called the Macaulay's duration, one is called the modified duration, and the third is called the complexity of bonds. Three very little bit sounding complicated, but very easy because you don't have to do any research on that. How they will found out what is what's the formula behind. Of course, I have shared the formula also. Okay, right. So duration. First of all, we must understand when we say duration, it means Macaulay duration. Okay? Now there is a guy called Macaulay. He gave a formula for calculating the duration of the bond. Okay. Now, what is the duration of bond? Please listen to me very carefully. The duration of the bond is, how much time it takes to recover your principal amount, what you have spent to buy the bond. If you buy a bond, in how many months or how many years it will take to get your principal back. Suppose a bond coupon rate is say 25%. It's a 10-year bond, and imagine that it's a high coupon rate, 25%. How much money will you get in a year? 25. 4 years you will get $100, isn't it? Without adjusting for the time value, within 4 years you are recovering your entire $100. But if you apply the time value, it will be 4.5 years, isn't it? So a 10-year bond will have a duration of 4.5 years. Let me just explain it to you. Now, suppose the duration means how much time it takes to recover your principal amount which you have invested in a bond. Okay. Now, suppose there is a bond which is having a 25% coupon rate of 100 rupees and it's a 10-year bond. So it will take you almost like 4 years and say 4.5 years. Of course, we apply the formula to get it right, but it is something which we apply the time value. Because 25, 100 rupees in 4 years, but if you apply the time value, it extends to the 50th year. When you recover all your 100 rupees back. Is that okay? Suppose if the bond is having a coupon rate of 20%. So what should be the duration of the bond? If it is 5 plus something, 5 point something, 5.5, it's the same. Isn't it? So a 10-year bond will have a duration of 4.5 years, depending upon the coupon rate. Isn't it? So if the coupon rate is higher, the bond duration goes down. One. Now, the higher the bond duration, the bond duration जितना ज़्यादा बड़ा होगा, जितना बड़ा होगा, it will be more risky. The bond riskiness will go up. It will be more sensitive to the interest rate. I told you the interest rate, the bond prices can go up and down. If the interest rate goes up, the bond prices fall. Okay. So, a Macaulay duration, a bond which is having a higher duration, will be more sensitive to the interest rate. Okay. A bond which is having a lower duration will be less sensitive to the interest rate. So if you don't want to take a risk, so which bond you are going to buy, a low duration or a high duration? Low duration. But if you think that in next 2 years the interest rates are going to come down, then you are going to venture into a long duration bond. Because then you are going to make money. Because the more the duration, the more the money you are going to get. Less the duration, the less the capital gain is going to earn. Is that okay? So let me just show you. So this is very important. Just open this Excel sheet. I prepared this after long back. Okay, and this is actually tells you the real story. Okay, so these are 20-year bond, 10-year bond, 5-year bond, 3-year bond, 2-year bond, 1-year bond. So I've taken all the bonds. Okay, so the face value is $100. Okay, and the coupon rate is 9%. Okay, so this bond, the first 20 years will run right up to 20 years, 2040. Okay, the 10-year bond will go for 10 years. 5-year bond will go up to 5 years. Okay, fine. Now just look at this bottom. This is a 20-year bond. Okay, the coupon rate is 9%. Suppose the interest rate is 9%. This bond will be selling at $100, isn't it? Now, if the interest rate goes down to 8%, the coupon rate, the bond will jump up to 109.82. So how much percentage it has gone up? 9.82%. So 1% decline in interest rate has given you 9 rupees 82 paisa as a capital gain. The bond you purchased at $100 is now selling at 109 rupees. This is the capital appreciation. Apart from the coupon rate, if you are getting 9 rupees, you get 9 rupees 82 paisa gain also. So you get almost like 90 rupees. Okay. When you sell in that year, you will get 19% return, more than even the equity return, isn't it? Right? It's what? 20-year bond. Now, if you go for a 10-year bond, this bond is going up by 86.7. The decline from 9 to 8% led to a 6 rupees 71 paisa increase in the price from 100 to 106, so we got 6.7%. Similarly, a 5-year bond reacted to 3.99. And similarly, if you go down and say, look at this. So a 5-year bond 3.99, 3-year bond 2.5, 2-year bond this thing. So if you think the interest rates are going to go down, where you are going to put the money? 30-year bond or 2-year bond? 30 years. Suppose it may happen the reverse side of it. Instead of the interest rate, coming down, it goes up. What happens there? Let's see. Next slide. So in this case, the 20-year coupon rate is 9%, so interest rate goes up to 10%. This bond is going to go down to 91.49 and you are going to lose 8 rupees, 8%, isn't it? And similarly, if you look at the bond, a 2-year bond, it will go down only by 1.7%. Is that okay? Fine. So, sometimes you bet on interest rates and you buy a bond. If you're lucky, interest rate goes down, you make a huge capital gain. But if you're unlucky, you will lose a lot of money. Even invested in a bond and you invest in a 20-year bond, you lose almost like 8 rupees in that year. Right? But there's always a way out. Don't sell the bond. Stay invested till the maturity and you're not going to lose anything. Is that okay? अगर आप ये bond hold करके नहीं बेचोगे, hold till 20 years, you're going to get the money. Maybe in some year you're lucky and the bond interest rate comes down, the bond price will go up. So wait for the your time instead of just being a short mistake. Is that okay? Is that clear? So the bond prices the longer now here I have seen the maturity period, isn't it? I have not related to Macaulay's duration. So let's now relate to Macaulay's duration. Okay. So I just go to the first one, rate sensitivity, and I put the Macaulay's duration formula here. So this is the formula here. Okay. Right. So I have said the bond starts on so date, ends on so date. So there are 20 days. So it's a 20-year bond. I have put 2 dates because the formula says that you have to put a date. It's an Excel sheet formula called duration. I'll explain you that. Then you say what is the coupon rate and what is the current rate of interest. Okay. So it will tell you the duration 10.37. So it's a 20-year bond, but the duration is 10.37. Fine. And there is something called modified duration. We'll also calculate that, which comes to 9.603, which means now this is a better ratio. Okay, which tells you 1% change will lead to how much change in the price of the bond. So it is 9.60 and see 9.82 which is coming out here. 1% change and Macaulay duration, modified duration formula is almost telling you near to that point because the duration have a convexity also, it will never match because if this is a linear relationship. Okay, linearly it may go up 9.82%. Okay, if suppose it goes 1%, then it is going to 9.82, but actually it is going to 9.63. Duration is telling you that you may gain or lose 9.6%. Okay, very near to what we have calculated. Now I'll tell you why there is a gap. Okay? It is the minus part because there is something called convexity of bonds. I'll explain that. Okay, is that clear? Is that clear? So now you can just change this. You can change this formula. So put it 30 here. Just say 30. So now this becomes a 10-year bond, isn't it? A 10-year bond. So what is the modified duration? 6.56, 6.71. Is that okay? Very near to that. Now make it, make it 5-year bond. Okay, so make it 225. So this comes to 3.93 and 3.99. Is that okay? Very near to number what we are getting. Okay. The formula is telling you, if you calculate this formula and arrive at this duration, it will tell you that 1% change in the bond in the interest rate will lead to what will increase in the bond price. So if it is, a 5-year bond, in this case it's a 5-year bond, so 1% change can lead to 3.9% up and down. Okay. So which we just, saw a 5-year bond was giving you 3.99. Okay. And here I'm getting 3.93 very near to the number. Is that okay? Now change it to a 2-year bond. Okay. 2-year bond. Make it to 2022. So it is 1.78, 1.77. Very near. A 1-year bond is far nearer. Okay. Is that okay? Is it clear? So just have a this thing and go now to the second slide and just try to see here the same thing. Duration you can calculate. Now it was coupon rate is 9%, maybe it is 10% because the interest rate is going up. So you can try all the things 20, 30, 25 or 22 and see whether it matches with this number. Just try this. आपका account number चलिए बैठिए नहीं. Okay, just have a you can just have a play with it. There is a laptop. मैंने बोला I'm getting it. Anybody is not following it. It's a simple one. I have to get my specs. Oh, specs I was carrying it. अब यही होता है specs रखा हूँ अपने पास and regards to the specs. A 1% change. If you make a 1% change there, what will be how much the bond prices will increase by 1%? So you're getting a opportunity. And it is also something very particular. 30-year bond. Just see the 30-year bond is 20-year bond. And see the 20-year bond. Duration is Macaulay's duration. Right? So it is actually, if you have to really just compete because of duration, which is the second one. There are two distinct duration and modified duration. Now, modified duration is a better metric because it tells you how much the bond is going to react with 1%. Macaulay's duration is basically, there's an offshoot of this Macaulay's is modified duration. So the number which you should focus on should be the modified duration and not the duration Macaulay's duration. Okay, fine. So the report relevance is the modified duration. Again. Now duration is basically, this is a slightly modified formula. There is a formula which is almost similar to that, but small different, and then you get this. Okay. Now I may not go into the formulas. Okay. The formulas will be read them. More accurate or relevant, more significant, more important. It completes and gives you a handle on what is going to happen on your bond prices, whether how much they are going to go up and how much they are going to go down. Is that okay? Fine. Now, there is some exercise given, so maybe in your final exam, there will be some exercise picked up from here. So you can do it later on. Okay? अजय हाँ गुड मॉर्निंग क्या कैसे डिमांड निकाली किस चीज पे हाँ क्या सेल था फ्लैट का सेल हुआ था हाँ 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 फिर नहीं वो, हाँ वो तो मेरा था। हाँ 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 हाँ, तो ये तो वहाँ, हाँ उसमें हमने दिखाया हुआ है, कोई कैपिटल गेन दिखाया हुआ उसके अंदर? अच्छा अच्छा अच्छा। हाँ तो हमने टैक्स तो पे कर दिया था ना। अच्छा तो अब इसका डिटेल कहाँ से पता चलेगा फिर? हाँ 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 हाँ। अच्छा सुनील से बात कर लेना, फिर मैं करूँगा, मैं अभी लेक्चर ले रहा हूँ, फिर बात करता हूँ आपसे थोड़ी देर में। हाँ सर से बता देना, ठीक है ठीक है। हाँ हाँ देखेंगे फिर, चलो ठीक है, ठीक है ठीक है, ओके ओके। Okay, now okay, let's understand how this formula is worked out. Okay, so duration here. Okay, so I put the formula here. I go to the formula here. Just have a look and go to duration. Okay, go to duration, and here I have to put these dates. Okay, fine. Settlement, maturity. Okay, coupon, and then the yield. So I just complete this and put here frequency. I'm putting one. That every year you are getting the interest coupon. Okay, so you are getting two 6 monthly, so you can put two. If you're getting every quarter interest rate, so it will change. Okay, so when I say okay, so I get 9.53. Is that okay? Then I can go to modify duration also and see the formula, modify duration. So similarly, I can put everything and then I can arrive in this formula, same formula almost. This, this, sorry, coupon and yield. Okay, frequency one. Okay, here I'll get the modified duration. It's coming 8.66. Okay, fine. It's Excel driven, so you don't have to go. You don't have to. I mean, understand. The formula. If you want to understand the formula, you can just go to the formula and understand it, and have more. I mean, this thing. So I'm just leaving it up here only. Otherwise, then we can just extend the topic to whatever level. Okay. Now, so another one. This is called convexity. So I'm just going to explain that. Okay. So I'm just going to first. I'm going to the convexity. Then we'll go at right from the start. Okay. Concepts. Okay. Can you read it? Who was reading it, please? Shubhangi, please read it. Shubhangi, can you read? Just okay. You can just read it from your laptop itself. You have to read louder. Just a second. Okay, okay, please start. Please listen now. Listen to Shubhangi, okay? Okay, just hold on. So duration is a linear measure. It's a first derivative of interest rate. Okay. Now we say that one person can lead to so much percentage of increase or decrease. So it's a linear. We always say the relationship linear, but the relationship is not linear. Okay. So yeah, so that means just before explaining all that, so there is, what we have so far understood that 1% change will lead to say so much percentage of change in the value of bond, but the relationship is not as linear as it looks. Okay, there is something called convexity. Okay, because the relationship is curved in nature and not linear in nature. Okay, so that's why we must understand what is convexity. Okay, and convexity is a second derivative of the interstate. Now it is like this. Okay, now see, like the interstates, when the interstate changes from 0 to 1, what happens? The bond price goes up. Okay, fine. So, and if we draw a relationship, the linear relationships look like this. So, this will be, the yield, and this will be the price. But actually, the relationship is curved. Okay, isn't it? So, there will be some curviness to the this thing, and interstate will not, go up in that fashion. Okay, so that is called the convexity. Okay. So let's understand what is convexity a little bit. We will not go more in detail, but we must understand there is something called convexity. Okay? It's good that today we are not having one gentleman, other than you're asking a lot of questions from me. Right? You can always think about that guy. Who's that guy? Yeah. Subena. He would have asked so many questions to me, and I would have actually just taken him to only a little bit about. I'm not going very deep into it. Okay? He would have tried to go in more deep. Fine. We are not doing doctorate in bonds. Fine. Okay. 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 Just we need a little louder voice. Okay. Fine. So I'll just speak it. So first point is the price yield relationship. When the interest rate change, the price of the bond typically moves in opposite direction. We know that. Okay. If the interest rate rise, the bond price actually fall, and if interest rate fall, the bond typically rises. So we know that. Okay. So linear versus non-relation linear is a simplified view. In a simplified view, the relationship between bond price and yield is often assumed to be linear, meaning that 1% change in yield result in a proportional change in the bond price. Okay. However, in reality, this relationship is not linear, and it is better described as a curve due to the concept of convexity. Okay. Convexity and curvature. Convexity is a measure of curvature of bond price yield relationship. It helps to account for the fact that the bond prices do not change proportionately with the yield changes. Instead, as the yield changes, the price yield relationship forms a curve which can be upward or downward sloping. Okay, fine. Importance. So, what is the importance of this convexity? Why we are doing it basically? Convexity is important for bond investors and traders because it affects the return and risk profile of the bonds. Okay. Bonds with higher convexity are less affected with the interest rate changes. So if you are buying a bond which have a higher convexity, the relationship with interest will be less. So when you don't want the interest rate should affect your portfolio, then you choose a lower duration with a higher convexity. Then you are going to save. Is that okay? So bonds with higher convexity are less affected by interest rate changes. So if you are a very conservative guy and you don't want and you think the interest rates are going to go up, okay, and the bond prices are going to fall, so better park your money into bonds which are having a low duration with higher convexity. So they are not going to impact your return. So that is basically the message out of it. Okay. Now the convexity of the bond is influenced by the time of maturity and coupon rate. So the convexity depends upon the bond maturity and coupon rate. Generally, bonds with longer maturities and lower coupon rate are higher convexity. Okay, because of the cash flows are more sensitive to interest rates. Okay, so we are just going to that you can just read that in hedging also it is being used. So I'm not going to take you much on the convexity, but you can just read and understand. Up to knowledge up to this is enough for you at the moment. But if you want to go more deeper, you can just think about that. Okay. Okay, so there are some some more slides are there which I'm just leaving it. Okay. So modified duration, we have already done it. Okay. So we just move on right from the slide number 1. Okay. Okay. Now the lecture begins for our exercise, our analysis. What we did in equity, we are going to do the similar exercise in bonds, and you are going to choose bonds, every nature of bonds, and just find out which bond is better, and make a Excel file calculation we do it for equity. Okay. So first of all, let's understand. So the first type of bond is overnight. There are about, I think, like we have equity, there are 13 categories. Here there are about 18 categories. First is called the overnight fund. Now here, the bond is like this, that the money is, some people require the money only for one day. Okay? It's not a bond. Like, bank requires the money for just one night. Because it has to meet the RBI regulation. It should invest some money into G-Secs of the government of India, because there are certain ratios called SLR ratio, statistics ratio. Have you done those ratios, repo rate, SLR ratio? So the bank needs to invest some money, park their money into securities. They can't let all the money got it as deposits, because to make the banks less risky, they need to buy some bonds. Okay. Oh, so there is overnight. So that means bond bank is taking a money for one day, one night. So these are instruments, they can be bought by the mutual funds, and they earn interest and pass on that interest to the investors. Now I can, be a investor in this kind of a bond fund where bank may need just for one day. Okay? So I will be putting some money, and that money will be for bank's need. Okay, so this is overnight. So first, overnight. These mutual funds invest in overnight instruments with maturity of just one day. Okay. Generally, the banks would be doing that. So these instruments will be bought by mutual funds. They are sitting with crores of rupees, and they finance this money for one day. And you get the return as an investor. When we invest into these funds, the return will come to us. Then liquid funds. Here, these funds invest in bonds and money market instruments with maturity of no longer than 91 days. So these are called liquid funds, where your money is parked on 91 days instruments. Okay, like CDs, CDs, treasury bills. So these are various money market instruments. So this is for 91 days. Liquid funds. Now, currently they are offering around 7% return. Now, earlier, most of the corporates, they used to, they're sitting with a lot of money. Like, when I was working in telecom, Idea, Vodafone, so, we used to have a lot of postpaid customers in our area. We used to have 50% postpaid customers. Now it's less than 1%. So the money would be collected from every nook and corner of India. There were about 6,000 villages or more than that. We were offering our postpaid customers, and they were giving money to the bank. The bank would, money will get pulled, right, and the money will go to Bombay in one account, say HDFC or ICICI, wherever the money is collected from, say any place like Solapur, or from any place in India, okay, or maybe Betul, Solapur, or Chitwada, or New Delhi, or Mumbai, or anywhere, okay, or Bandra, or wherever. So money will get pulled down, and in the evening at 5 o'clock, the money will come to one account. It will be crores of money which will get pulled. The money being collected all over India, all our postpaid customers they are paying, and the money will be reflected in our account in the evening at Mumbai, our head office. So we'll be having, say, 100 crores today. Now that money needs to be parked immediately. We don't have immediate requirement to spend that money. So we will be putting that money in liquid funds. So that's called treasury management. So we can put it for 7 days, 3 days, 4 days till we need money, which will earn about 7%. As against 0% on a current account. Okay, we can't have a saving account as a company. So if you put the money in a liquid fund, we get around 7%. It will depend from time to time. That time was 7%. Let's see what is happening now. Then we have the money market instruments. So these mutual funds invest in money market instruments with a maturity of no longer than 12 months. So 1 year money market instruments, like CDs, CPs, or repos, or whatever. So these are the various kinds of money markets, and we'll see how much each category of fund is giving you a return, and where you should be putting your money. Then we have low duration. Now this is the best fund. This is basically competing with fixed deposits in a bank. So we have a money, so we want to take a fixed deposit in a bank or go to a low duration fund. This is directly competing with a fixed deposit of Indian banks. Till 31st of March, this was a better instrument compared to a fixed deposit, because you don't have to pay any income tax on low duration. You can enjoy a benefit of indexation. But now the indexation ban is taken away by the government because the banks are cribbing it. So money was not going to the banks, money was all getting parked into low duration funds. So the banks were short of funds. So they requested the finance minister that this law should be changed. Because the money which you get from low duration is called a capital gain. Okay, you are taxed only in the year when you sell it. Whereas if you put a money in a fixed deposit, you will be taxed every year. The return will be on the basis of the tax deducted. So that still continues. So that's why the much better fund compared to a fixed deposit. Still, okay. Then we have short duration and ultra short duration. So let's look at the first low duration. No, these are competing directly with the fixed deposits. So these funds, anybody who has a louder voice, please. Can you read? Anybody? Yeah, you can speak. Yeah. थोड़ा तेज अच्छा आवाज से. Shivangi needs some, more exercises, some more proteins or something, which can make her voice more louder. Okay.
These mutual funds select bonds, debt, instruments as their average maturity remaining period for portfolios between 6 to 12 months, Macaulay duration. Shorter duration funds will provide lower returns but are lesser risky to interest rate changes.
Okay, fine. So this is a low duration funds. They are competing directly against a fixed deposit and not mention it. So these are having a short duration. How much duration? 6 to 12 months. But I have made a chart which will give you a full comparison for each fund. Okay, short duration fund. Read.
Short duration funds. These mutual funds select bonds, debt for investments as their average maturity period for portfolios between 1 to 3 years.
So which fund is more riskier, low duration or short duration? Please raise your hand and answer. Which fund is more riskier, low duration or short duration? This is what we have done so far. Which one is more riskier? Huh? Short duration. Because there the Macaulay duration is between 1 to 3 years. Here the Macaulay duration is 6 to 12 months. So this is less sensitive to interest rate, this is more sensitive. Okay. So here your portfolio will be very volatile. If the interest rate goes down, your NAV of the mutual fund will go up. If the interest rates go down, then mutual fund will give you a higher return. But if the interest rates go up, then the bond value will fall and you lose money. Is that okay? Right? If you are holding these two bonds, you will find here you are not losing much or you are not gaining much. You are gaining and losing only because of the coupon rate. And here, apart from the coupon rate, the capital gain or capital loss will be much pronounced. Is that okay? Then the ultra short duration, okay, where the duration is only between 3 to 6 months. So this seems to be the lowest, in terms of riskiness, followed by this and followed by this. Is that okay? Okay. Yeah. Exit load, yeah. That's why the liquid funds earlier, but now, because this has become less, I was telling you, our corporate office used to invest in liquid funds 3 days, 4 days, but now there is some kind of an exit load which is charged if you take out money within 7 days. Fine. So there are exit loads. You must check the exit loads before putting the money for a short term or a liquid fund because you may lose some money.
So, what will be losing money if we invest in each liquid? Because if we go for 7% annual rate and we are being charged 0.5% as an exit,
yeah. Then you lose this. So you have to remain risk for at least 7 days. Now. Just check how many number of days you should be there so that there is no exit. If you can hold the money for 7 days, then liquid funds also give you a better return. So just see that exit flow when we come to that liquid funds. So then we can make a decision. Now, just look at the fixed deposit rates, and then you can just say, this is the interest rates, okay? Fine. Or for the fixed deposit. So this is, the bank FDs, okay, for senior citizens and for general citizens. Okay, so we'll just focus on general citizens. Today the interest rates are, the higher rates are around 7.5%. So what I have done, I've just picked up on the basis of duration here, on the basis of how many days you are putting up FD. So if you're taking 7 to 14 days in FD in a bank, it is giving you 3.25%. This is one bank called HDFC Bank. Okay. Then if you're putting for say 18 months, you're getting 7.5%. Okay. So now this is directly competing with a low duration where it is between 1 or 2 years of maturity period. So you get 7.5% in a fixed deposit. Then you get in a low duration. If you get more, put your money in low duration rather than putting in a fixed deposit. So you can always make a comparison which is giving you more. Normally a low duration will always win against a FD. Because of its tax benefit, before the minimum mark, now that is gone. But because of its higher interest, then of course you should be low duration. And here the low duration, the tax will be only when you sell it. In fixed deposit, you will be subject to tax, yearly tax, at any basis. Okay. If you are having a 10 lakh rupees fixed deposit and you are earning, say, some 7,000 rupees or 80,000 rupees interest, 10% will be slashed and then the rest will be paid. But here, in a low duration, no deduction, unless you sell it, because you are not made the return. Okay, because the returns can go up and down only in the year when you sell, then only it will be counted as the income, otherwise not. Is that okay? So then we have, debt mutual fund, medium duration, okay, long duration. So the long duration is the riskiest because it has a Macaulay duration close to about 7 years, okay, fine. And this is 4 to 7 year medium. And now in these funds you are going to put money only. Then you think what will happen to the interest rates? Go up and down. Huh? If the interest rates come down, you think that next 3 years the interest rates are going to come down, then park your money here, otherwise you are in trouble. Okay? Because you will lose it.
So we will only lose the money if we are going to sell in the market, right?
That's a very important question. Because here the money is not in your hand. The bonds are not in your hand, it is in the hands of the fund manager. If he doesn't sell, you still going to get your money. But suppose he takes a decision to exit from the bond, whatever loss or gain you're getting, you will pass on. Is that okay? Fine. If you buy the bond yourself, you can hold till maturity, you're not going to get back. But when you buy a mutual fund, a long-term duration, if the interest rates go up, the bond price falls. If the fund manager sold it, then you will lose it. Okay, because that remains out. Now, fund manager is not going to sell it. He's not a fool. Okay, he will hold it. Right? But there is always risk. So then some more before the break. Break, if you tell me. Uh, So let's just complete this, okay? Other categories will take like 2 minutes more, 5 minutes more. So gilt funds with 10-year consideration, target maturity fund, floater funds. So there are some more funds, okay? Fine. So now here the money is invested only in government securities. Here no money goes to corporate funds. The money goes to only a 10-year duration. So these are risky because it's a 10-year Macaulay duration, but the money is being put only into government securities and nothing else. Okay. Then target maturity. Here basically they are saying that it's a 10-year bond. We are going to invest right from the beginning till end. So that means there is no chance of any capital gain or loss. Okay, if you hold on to it before. The closed-ended fund, it's a 3-year bond, so we're not going to lose anything. Whatever is the coupon rate, that is the return we're going to get. So we'll look into it and we'll examine that. Then floater fund, and just moving to the most important ones. The credit risk fund, this is very important. Now, the fund manager can invest into bonds. Now, he can invest bonds which are lower rated, okay, which gives you a higher return. Because it is a B category bond, the highest rating is triple A, followed by double A, followed by single A, then by triple B, double B, and single B. A B rated bond, suppose it's a company, okay, Mangalam Finance or something, okay, which we don't like to invest. Suppose Mangalam Finance is a poor company, which is a single B company. Okay, now it says that if you give the money to us, we'll give you 9% return. But if you give the same money to Reliance Fund or Reliance Bond, they'll give you only 7.5%. Now, Mangalam Finance is giving you 9.5% or 10%. So that means if they are investing into the credit risk fund, which is having higher risk because of the low rating, so you will get 10% return, okay? But you take a risk, isn't it? Fine. But presently, all the credit risk funds they are investing in double A or single A at the most, not beyond that. So risk is less, but you get only 0.5% more return compared to the normal funds. So fixed maturity plans, they are now been out of fashion. Okay. Now this is the various. Let me just complete 1 or 2 more slides. Okay. So this is I've given a full summary about what is the Macaulay duration for these bonds. Okay. Fine. So you can just look. One last slide, and then we can just go for a break. Yeah. So let's look at the returns offered by this. This is a very important one. Okay, and we will start from this slide itself. Look at the how much return you are getting, 1 year return, each category of funds which gets back. Overnight, what is the present return we are getting? So this is the highest return of any fund scheme. I've kept the highest return. So overnight, Mirai asset is giving you 6.5%. Liquid fund, Aditya Birla, this is liquid fund, 7%. Low duration, 7.76. Now, how much statistical will give you? Uh, uh, how much? 7.5% of the chart. So this is 7.6. So if you have to choose between a liquid fund or low duration or a fixed deposit, you will go for low duration because it's being higher. Then short duration 7.79 because here the duration goes up, so return also goes up. Sorry, duration is less compared to the ultra is less, 7.5%. Medium duration 8.22. Medium to long duration. Now, if you see, all these long duration funds are going to be higher. Why? Because over the last 6 months to 1 year, the interest rates have fallen. Okay, but very lately in the last month after this, Israel war, for that the interest rates have started going up again. Okay, so when the interest rates have been going down, these funds have been performing better and giving you higher returns compared to all other funds. Because here the duration was higher, so because the interest rate went down, and not down greatly, but small dip, and it just started giving you higher returns. This is where the interest rates are coming down in India or anywhere in the world, so these funds are going to outperform all other funds. Now, this is a dynamic bond fund. Okay? They can any bond. If they think that the interest rates are going to go down, they're going to put in long duration. If they think the interest rates are going to go up, they're going to exit from long duration and put your money in. So you don't have to do that this thing. So to be very safe, these funds are always better to put in. Because the fund manager is going to decide where to put your money, long duration or short duration, depending upon their forecast of interest rates. Then corporate bond funds, here the risk is higher, but the return also goes up, 7.97. Here the money is going to corporate companies of India. Then we have gilt funds, then credit risk fund 9.12%. Because here the risk is the highest because they are investing in low rated securities, single A, double A, so they give you higher returns. Is that okay? Have a look, and if you have any question, please ask me. Otherwise, we can start it from the same slide again. Is it so far clear what we have done so far? Understood? A break for 15 minutes. So, it's 12:06 and the break will be up to 12:25, 26. Please come on time.